Well, let's continue our discussion with Aaron Smith, Singapore Managing Director of Superfund Financial, and joins us now from our Singapore newsroom. Aaron, let's talk commodities now, because sugar has been on an absolute tear, but it scales some pretty heady heights. Is it looking a bit top-heavy at the moment, due for a correction?
I don't think so. I think sugar's in a beautiful uptrend. Basically, we saw a trend channel, which was essentially broken on the upside in August when sugar went above $22 per. That was a major area, and now we see a little bit of consolidation, but Superfund continues to maintain long positions in sugar. I think that sugar can go significantly higher, and I think in the long run we're probably going to go back to the highs that we saw in the 70s. There were two times in 74 and 79 when sugar made its highs, and I think that we're going to get at least to $50 sugar probably in the next few years.
But these are staggering gains that sugar has made, Aaron. As far as the fundamental supply and demand picture is concerned, does the price really reflect what's going on in the market?
Well, in some ways it does. I mean, I guess the fundamental story, and I'm not a fundamentalist, but the fundamental story is the shortage in Brazil of sugar output, as well as the lack of the good rains in India, as well as huge hoarding of sugar for the Diwali festival coming up. But I think in the long term, the outlook for sugar and for most commodities is quite bullish, especially because we think inflation will come into the market and in the long run, and that's going to add to the uptrend that we see.
And let's talk gold. Talking about inflation, Aaron, we seem to be holding quite well above this $1,000 an ounce handle, but is it possible that we could take out the highs that we saw for futures back in March 2008, which I believe was around 1,034?
Look, if you draw a line that goes back to the 2008 high of 1033, we're basically right just crossing over that resistance line, and the gold price is held very well at that point. On the other side, in the past year, we've seen a nice uptrend. And I know you've heard me many times on CNBC spout the merits of investing in gold as the only true currency, the only real form of money on the planet. I think that for a number of reasons, gold could go much, much higher and certainly could break the highs that we saw in 2008 March. But there's going to be pressure from the IMF. The IMF is going to say things like they're trying to help out, starving nations and therefore sell gold. They're, of course, the third largest holder of gold in the world. The U.S. dollar might try to defend the integrity of the U.S. dollar. The U.S. Treasury may try to defend the integrity of the U.S. dollar by selling gold. Of course, the U.S. holds more gold than any other nation in the world. But curiously, the U.S. only has 0.7% of all the world's reserve assets. So if you look at a country like China, which is actually number 7 on the list in terms of gold reserves, I think that they're going to be very ambitious in accumulating gold steadily for the long run.
That's a really interesting point, Aaron, because you mentioned that if we do see the IMF trying to sell gold into the market, then it may not even find its way onto the market because the Chinese will buy it. As you mentioned, they're trying to diversify their holdings of U.S. securities away from dollar.
Should do happily. The Chinese government as well as Chinese individuals are now being encouraged to buy gold. Indians, which own 16% of all the gold in the world, which is $800 billion, have hoarded gold and have it at home, and they're buying gold in the Diwali season coming up.
Do you think that the Diwali buying season is going to push prices even higher?
I think it will, and even Americans are buying gold for the first time. We see now that the GLD, the ETF for gold, has surpassed China in terms of its holdings. So it's actually the 6th largest holder of gold in the world, which represents private investors rather than governments. So now we see private investors actually challenging sovereign governments in terms of gold ownership. And this is very, very important. I think that if you talk to my mentor, who's the founder and owner of Superfund, he would say that gold will easily trade at $2,000 per ounce in the next 3 to 5 years. And I firmly believe that's true.
And Aaron, just before we go, as far as the investment route is concerned for gold, if you want to play that, is it through the miners like Barrick? Is it through the ETFs, or is it through the physical bullion?
The best way, well, obviously you should own some physical. You should also own silver because the gold to silver ratio is way out of whack. It's going to come down significantly, and silver's a good buy. But the best way to get exposure to gold, besides physical ownership, that's the best way. But the other way is something kind of a new innovation that's only come into the market in 2005, which is a gold-denominated fund. So you could buy an investment fund which is priced in gold rather than in dollars or sterling or euro. So we've done that at Superfund. We have Superfund Gold, and that way you have an investment product priced in ounces of gold. And doesn't that make sense? Because isn't gold a currency? It's not really an investment, it's more of a currency. It should protect its value, it won't have inflation, they can only mine about 0.5% of the total, there's 155,000 tons of gold in the world, and that's only increasing by 0.5% a year, and it's getting more and more expensive to mine that gold. So the long-term direction is going to be very bullish. So what can you do as an investor? Two things. First of all, buy and hold investing in stocks is dead. The last 10 years is the best case scenario for the next 10 years. I think that the equity markets will actually be worse. You'll see just periods of boom and bust based on stimulus. So what can you do? Number one, you can buy and hold hard assets like agricultural land, like gold, like physical commodities. I wouldn't touch the mining shares because they have leverage, they have debt, they have liabilities, they have a CEO that can cook the books, they have an auditor that can cheat and steal like what we've seen many, many times in the past decade. So why even go into a commodity company when you can have the physical commodity itself, which has no leverage, which has no liabilities? And the second thing is that I think the more astute investors, the top 1% of the wealthiest investors of the world certainly, are buying systematic strategies like managed futures funds that can make money when we see uptrends as well as downtrends in the market.
All right. Aaron, it's always good to have some actionable strategic advice that our viewers can use. Thank you very much for your time today. That's Aaron Smith from Superfund Financial.